Hello, my name is Nicole Elliott and I'm a technical analyst and private investor. And today I thought we'd look at government bond yields. We're going to start off with the yield on a 10-year German Bund. And the reason I've picked this one is that once again it's down at a record low of just under zero. So it's negative, one of the many bonds that are now got negative nominal or real interest rates. And the point here is that the move to lower interest rates has really been a secular one. In Germany, it started in 1981, 1980 in the United States, far later in Britain, but it is a secular move. It gained traction post-German unification, and then again during the financial crisis, it picked up the pace. So lower yields are here for a very long time. They're nothing new, and just because they're less than zero doesn't mean to say you don't want to own them, because as the yield goes down, the value of these things, the price of them, the nominal price goes up. So it's not a zero-sum game, and it's not a minus-sum game either. So keep that in mind, particularly if you're planning not to hold them to delivery. The other point is that you may prefer not to leave your money in a German bank, particularly if you're a very large corporate customer where your petty cash might be 100 million euros. Well, nobody's going to bail you out, are they? So that's one of the reasons that this has been pushing. And what also reminded me is that financial stability report from the ECB, biannual exercise, was published yesterday, and Luis de Guindos admitted that he was very worried about the financial stability in the Eurozone itself. My second chart is a weekly chart, and it shows how the yield on key US 10-year paper, 10-year Treasury notes, the yields backed up in 2016 and then formed a broadening top just above the psychological 3%. Now, in my opinion, yields above 3% on this paper are unsustainable, and this has been the case since 2011, so it's nothing new. Now we're on the way down again. We've retraced half, in other words, undone half of the backup that we've seen, and I think there's more to come. I mean, particularly, as I say, if the bunds are nothing, I mean, here at 2.25%, it's not insignificant. And my third chart is the 5-year UK index-linked price. Now, this has moved from £111 to £114 this year, so that's a gain of 2.7% in the face value of this thing. Now, had I opted for a longer maturity, the price impact is bigger, right? So long duration, bigger price moves. So, for example, the 10-year US equivalent, it's called a TIPS, Treasury Inflation Protected Security. The 10-year TIPS is up 10% in face value already this year. So not bad going as we've just had 5 months worth of that.